All right, let's jump right in. If you're studying finance or accounting, you know that the entire world pretty much runs on smart financial decisions. But, how are those big calls actually made? Well, today we're going to break down the core tools every modern analyst needs, from figuring out risk all the way to predicting the future. We're building the essential toolkit, one piece at a time.
So let's kick things off with a huge scenario. Imagine this. You're the analyst. A company walks in and asks for €500 million. Your only job is to say yes or no. Now, this isn't about a gut feeling, right? It's a process, and that exact process is what we're going to unpack today. So here's our game plan. We'll start with the absolute bedrock. What is credit risk? Then we'll get our hands dirty and actually analyze a company's credit. From there, we'll look into the future with financial modeling, and then we'll supercharge that with data analytics. And finally, we'll pull it all together into one seriously powerful modern toolkit. Okay, first things first. Before you even think about lending money or buying a company's bonds, you have to understand the risk. And it all boils down to one fundamental idea: credit risk.
So what is credit risk, really? Well, in the simplest terms, it's the chance you won't get paid back. Let's say a company issues bonds to raise money, but then, a few years down the line, they can't make the interest payments or pay back the principal. That potential for failure? That's credit risk in a nutshell.
So how do we actually measure this risk? Professionals do something called credit analysis. And the whole point, the real goal here, is to answer one question. Does the company generate enough cold, hard cash to pay its debts on time? And it's not just banks asking this. Investors do it, and so do the big rating agencies you've heard of, like S&P and Moody's. All right, that's enough theory. Let's make this real. We're going to put on our analyst hats and do a credit assessment for a company we'll call Eurosteel Ltd. And yep, they're the ones asking for that cool €500 million. Now, here are the key numbers we get to play with. Don't worry, we're not going to get lost in a giant spreadsheet. We're just going to focus on a few key things to get a good snapshot: total debt, equity, operating income, interest payments, and its cash flow. Think of these as our clues in a financial mystery. Our first tool from the toolkit is a classic, the debt-to-equity ratio. It answers a really simple question: how much is this company relying on borrowed money versus its own funds? It's all about leverage.
Okay, let's run the numbers. We take Eurosteel's total liabilities, that's $1.9 billion, and we divide it by its equity of $1.3 billion. And what do we get? 1.46. But what does that number actually mean? Honestly, on its own, not a whole lot. The magic happens when we put it in context.
And this is where benchmarking is so important. We compare Eurosteel's 1.46 to the industry average, which is 1.50. See that? They're basically right on the money. It tells us they aren't using a crazy amount of debt compared to their peers. So first check, looks good. All right, let's grab our next tool. It's the interest coverage ratio. This one asks another critical question. Does the company earn enough profit to easily cover its interest payments? It's a direct look at profitability versus the cost of its debt. For this, we look at their EBIT. That's just earnings before interest and taxes. Basically the profit from their day-to-day business. That's €600 million. We divide that by their annual interest bill of €80 million, and that gives us a ratio of 7.5. And again, we compare it. The industry benchmark is 5. Eurosteel is at 7.5. This is a fantastic sign. It means their profits could cover their interest payments 7.5 times over. They've got a really healthy cushion, way better than the average. Okay, for our final ratio in this quick check, we're looking at the most important thing: cash. You know, profit is an opinion, but cash is a fact. This ratio tells us if the company's daily operations are generating enough real cash to handle all of its debts.
So we'll take their cash flow from operations, that's €500 million, and divide it by their total liabilities of €1.9 billion, and that gives us a nice, solid 26.3%.
The industry average here is 20%. Eurosteel is hitting over 26%. That is significantly healthier. So when we look at their debt levels, their profitability, and their cash flow, Eurosteel's current financial picture looks pretty solid. Our initial analysis is a thumbs up. But, a great analyst never just looks in their rearview mirror. The really big question is what happens next? And that's where our next major tool comes in: financial modeling. This is how we go from analyzing today to forecasting tomorrow. Now, building a financial model isn't some kind of dark art. It's a very logical 6-step process. First, you figure out your goal. Then you grab historical data to see what happened in the past. Third, you identify the key things that really move the needle for the business. Then you make educated assumptions about the future, you build the actual model, and, this is crucial, you test it to make sure it works. This process lets you play out different scenarios and get a real feel for the company's future.
So we've got our analysis of the past and a way to model the future. But how do we make those future assumptions as smart as they can possibly be? Well, this is where we bring in the real game changer, the power of data analytics. Think of analytics as a journey. It starts with descriptive analytics. That's just looking at a report and seeing what happened. Then you move to diagnostic, which is figuring out why it happened. But the final step, the most powerful one, is predictive analytics. This is where we use data to forecast what is likely to happen next. This is how we make our financial models for a company like Eurosteel incredibly accurate and dynamic. Okay, so let's pull all of these different threads together now. We've talked about credit analysis, financial modeling, and data analytics. How do they all fit into one seamless toolkit?
Here's the most important thing to remember. These are not separate jobs. The magic happens when you use them together. You use credit analysis to see where the company stands right now. You use financial modeling to map out where it could go. And you use data analytics to make that map as reliable as possible. For anyone making a big money decision, this integrated toolkit is absolutely essential.
And that brings us right back to where we started, that €500 million question. You've looked at the past, you've modeled the future, and you've used data to sharpen your view. You now have the fundamental toolkit. So are you ready to make the call on Eurosteel? That, right there, is the power of financial analysis.